What if the biggest secret to multi-generational wealth isn't knowing which asset will skyrocket next, but knowing exactly how to combine investments that have absolutely nothing to do with each other? It's C. When a market crash wipes out the stock market, or when a massive inflationary wave destroys the purchasing power of cash, the average retail investor panics. They watch their life savings disappear on a red screen, completely paralyzed by fear, reacting to the headlines on CNBC or Twitter. They buy at the absolute top out of greed, and they sell at the absolute bottom out of desperation. But while the middle class is being systematically hollowed out by these violent economic shifts, the ultra-wealthy, the elite corporate institutions, and the world's largest hedge funds remain perfectly calm. In fact, they don't just survive economic crises, they structurally position their portfolios to profit from them. At C, this isn't because they possess a secret crystal ball, and it isn't because they are luckier than you. According to billionaire macro investor Ray Dalio, the legendary founder of Bridgewater Associates, the ultra-wealthy operate on a completely different financial playbook. While the retail public spends hundreds of hours trying to guess the next winning stock, the elite focus entirely on systemic architecture. Dalio spent decades managing over $150 billion for central banks, sovereign wealth funds, and tech billionaires. During that time, he discovered a mathematical breakthrough that he officially terms the Holy Grail of Investing. At C, in this video, we are going to unlock the exact mechanics of the Bridgewater playbook. We will look at pure historical data to reveal the hidden formula that corporate elites use to protect their wealth from central bank intervention, how to reduce your portfolio's total risk by up to 80% without lowering your long-term returns, and step by step, exactly how you can apply this multi-billion-dollar framework to your personal account today. Welcome to the inner circle of capital allocation. At C, to understand why the average investor loses money during a paradigm shift, we have to look at the fundamental flaw of conventional diversification. If you ask a typical financial advisor how to manage risk, they will tell you to buy a broad basket of stocks or a generic index fund. They will say if you own 500 different companies, you are perfectly diversified, but Ray Dalio discovered that this is a mathematical illusion. At C, think about it this way. If you own 10 different tech stocks, 10 different airline stocks, and 10 different retail brands, you don't actually own 30 independent investments. You own 30 assets that are all deeply tied to the exact same underlying economic environment. When consumer spending drops, when corporate taxes rise, or when the Federal Reserve aggressively hikes interest rates, all 30 of those stocks will drop like stones at the exact same time. They are all highly correlated. True diversification is not about the number of things you own, it is about the structural independence of the things you own. At C, during his early days building Bridgewater, Ray Dalio sat down with his team of elite mathematicians to solve a critical equation. He wanted to know exactly what happens to the volatility of a portfolio when you add assets that move independently of one another. What he discovered changed the history of hedge fund management forever. Dalio mapped out that if you add investments that have a zero correlation to each other, the total risk of the portfolio drops exponentially. At C, look at the mathematics behind the Holy Grail chart that Dalio published. If you hold just one single asset, your risk is 100%. If you add a second asset that is 50% correlated to the first, your total risk barely drops. But if you hold 15 to 20 independent, uncorrelated streams of return, your total risk drops by a staggering 80%. Let that sink in. By simply arranging your capital into independent pillars, you wipe out 4/5 of your risk profile, while your long-term expected return stays exactly the same. You create an asymmetric upward curve that is structurally protected against catastrophic drawdowns. Dalio realized that this mathematical certainty was the ultimate cheat code for wealth preservation. At C, but how did the corporate elite actually find these uncorrelated streams of return? The Bridgewater playbook splits the world into 4 distinct asset groups designed to thrive in different macroeconomic climates. Every economic cycle in human history is driven by 2 simple factors: growth and inflation. This creates 4 structural seasons. Season number 1 is higher than expected growth. During this period, consumer demand is booming, unemployment is low, and corporations are highly profitable. The assets that dominate this season are equities, high-yield corporate bonds, and real estate. This is the environment where traditional retail investors make all their money. B. Season number 2 is lower than expected growth, commonly known as a recession. In this environment, corporate earnings collapse, consumer spending freezes, and companies go bankrupt. Traditional stocks plummet, but this is the exact season where government treasury bonds excel. As panic spreads across Wall Street, institutional capital flees risky corporate assets and floods into safe haven government debt, driving bond prices up and offsetting the equity losses. Season number 3 is higher than expected inflation. This is the ultimate nightmare for the middle class, where the value of paper currency devalues rapidly and the real cost of living surges. High inflation destroys traditional bonds because their fixed yields can no longer keep pace with the rising cost of goods, and it crushes stocks because corporate margins get squeezed. But this is the environment where hard assets shine. Physical commodities, raw materials, energy infrastructure, and gold skyrocket during inflationary cycles because their supply cannot be artificially expanded by a central bank printing press. B. Season number 4 is lower than expected inflation or deflationary stagnation. In this rare climate, credit contracts, asset prices collapse, and cash becomes king. Short-term treasury bills and high-quality liquid cash preserves its value while everything else drops. B. The corporate 1% do not try to guess which season is coming next month. They know that predicting macroeconomics is a fool's errand. Instead, they build a portfolio that assigns an equal amount of risk to each of these 4 distinct buckets. Because the assets in these buckets are structurally uncorrelated, when one season hits a severe storm, another part of the portfolio is experiencing a massive bull run. The independent movements neutralize the violent crashes, ensuring that the total capital baseline moves steadily upward with almost zero volatility. This is the foundation of the famous all-weather framework that protects institutional billions. B. Now, let's step into the execution phase of the playbook. How do you take this institutional logic and apply it to your own personal portfolio to protect your hard-earned wealth today? You must stop looking at your investments as a list of tickers and start viewing them as independent risk modules. The Bridgewater strategy requires you to divide your capital into 3 distinct, non-correlated pillars that you can easily access on your phone or computer. B. Pillar number 1 is your global equity module. This represents 30% of your capital allocation. Instead of concentrating all your money into the U.S. stock market or high-growth tech companies, you must diversify globally. You use low-cost index funds like the Vanguard Total Stock Market ETF, ticker symbol VTI, combined with an international index fund like the Vanguard Total International Stock ETF, ticker symbol VXUS. This ensures that your growth engine is tied to the productivity of the entire world, not just a single country's political system or currency press. B. Pillar number 2 is your fixed income protection module, representing 55% of your portfolio. This core is divided into 2 parts, 40% in long-term treasury bonds using the iShares 20 plus year treasury bond ETF, ticker symbol TLT, and 15% in intermediate bonds using the iShares 7-to-1 year treasury bond ETF, ticker symbol IEF. This massive defensive block acts as your insurance policy against a severe equity crash, deflation, and corporate recession. While it seems boring during a stock market boom, it is the anchor that prevents your capital from experiencing terminal damage when the economic cycle inevitably turns. B. Pillar number 3 is your hard asset inflation shield, representing the final 15% of your capital. This is split evenly between gold and diversified commodities. You allocate 7.5% to gold using the SPDR Gold Shares ETF, ticker symbol GLD, and 7.5% to commodities using the Invesco DB Commodity Index Tracking Fund, ticker symbol DBC. This module has a zero or negative correlation to your stocks and bonds. When a currency crisis erupts or geopolitical tensions spike, this 15% block will experience massive vertical moves, protecting your total purchasing power from being inflated away by central bank intervention. To make the Bridgewater playbook actually work over the long term, you must enforce the mechanical rule of periodic rebalancing. This is the exact point where retail investors fail and corporate elites win. When the stock market is on an incredible multi-year run, human emotion screams at you to sell your gold and bonds and put everything into stocks. But the playbook completely removes human emotion. Once a year or once a quarter, you must look at your target percentages. If stocks have grown to 40% of your portfolio, You systematically sell that extra 10% at the absolute peak and use that cash to buy the underperformed bonds or commodities that are currently sitting at a discount. You are mathematically forced to sell high and buy low, completely ignoring the media narrative. End of. Ray Dalio's Holy Grail framework is not a get-rich-quick scheme. It is an engineering marvel designed for the ultimate survival of capital. The 1% understand that the current global monetary system is sitting on a mountain of unpayable debt. They know that central banks have no choice but to continuously devalue paper currency to sustain the system. By shifting your strategy from speculative guessing to structural risk parity, you insulate your family from the systemic traps of the middle class. You stop playing a rigged game and start investing like an institution. Optimize your allocation, automate your discipline, and protect your freedom.